So good morning again. For those of you who know me, I'm sure you see a post-COVID look with a new beard, but I'm very COVID compliant. Okay, so I hope you can see my screen. Okay, so we'll start with talking about investing generally and getting started with investments. Everybody wants to make money, and we all need to invest as one of the ways in which we can make money, especially if you haven't started and are not running your own business. And we will look at some investment alternatives that generally people would look out for. We'll talk about an introduction to the stock markets. We'll look at stock market investing itself, some of the returns that people have made on the stock exchange. We try and paint a picture of the reality so we can all see what should we look out for if we are going to buy stocks, and how should we invest, and then finally we can look at some recommended investments before we go to the question and answer session. Okay. So let's just dive in. Getting started with investing. I'm sure one of the most popular investors we all know is Warren Buffett. And he defines investing as the process of laying out money now so that you can receive more money in the future. This is something that we can all align with. Everybody wants to put some money aside so that we can make more money in the future, which means you put money aside and you expect your money to be working for you, as that money is kept aside, and to provide you a return. So the goal of investing really is to put your money to work in one or more investment vehicles, and that emphasis on investment vehicles in the hopes of growing your money over time. And there are several investment vehicles. More recently in our country, several people have touted different ways and promised ways in which they can deliver returns to people. Men's Gold is one. It was an investment vehicle. People put their money in there, they lost money. Government securities are another. But there are different investment vehicles available to you if you want to put your money to work for a return in the future. Now, people look or choose investment vehicles based on their own preferences. Okay, so what your objectives are? I want to have a wedding in 3 years. I'm saving for my retirement, or I want to buy a car. I want to go on holiday. I'm saving for my kids' education. So your investment objectives generally determine what kind of investment vehicle into which you are going to put your money. And then your risk preference. Are you somebody who cannot afford to lose any amount of money? Are you okay with taking some risk so that over time your money will grow faster for you? Okay, so every investor would have to align his investment goals or investment objectives to the investment vehicle. So your investment objectives, your risk preference, and then the time horizon will go a large way to determine what kind of investment vehicle that you're going to choose to make a return for you. Now, when it comes to investing, there's one basic rule we should all remember: return and risk. There's a trade-off. When you are investing, we say the higher the risk, the higher the return. Or wherever you see a higher return, it means there's also a high risk. So it's a rule that you should keep in mind. If you are going to invest and you want to make a higher return, then it means you're likely to be taking on a higher risk. So if somebody is promising to give you 50% per annum on your investment, then you know you're taking a higher risk. So it is a trade-off that everybody must keep in mind. If you want to make a higher return, you will be taking on a higher risk. And this is what you need to examine before you start your investment journey. Am I willing to take on a higher risk in order to get on a higher return? Usually your investment advisor will say you will spread your investments across multiple investment vehicles so that some of your investments would be in higher risk and some would be in low risk investments, so that at the end of the day, you have a portfolio. A portfolio is a collection of different investments within your own vehicle. That gives you varying degrees of return varying degrees of return to meet your investment objectives. So it's important that we remember the risk-return trade-off. Now, in investing, we have two sides. We've got money markets and capital markets. Money markets usually deals with financial instruments with maturities of up to 1 year. So we have investments like treasury bills, commercial papers, collective investment schemes. If you want to invest up to 1 year, you can put your money in these investments. Then you've got the capital markets, which deals in financial instruments with maturities beyond 1 year. So there you have what we are going to focus on, especially today, equity securities. You have treasury notes and bonds. You have foreign exchange, you have derivatives, and then you also have other collective investment schemes. So you see money markets are short-term investments. Capital markets are long-term investments. And capital markets include equity securities, which is the focus of our discussion today. So even by way of our introduction, we see capital markets, which means that they are invested in the long-term end of the financial markets. So equity securities means you are investing for the long term. So that is the basic, breakdown when it comes to the financial markets. And if you are looking to invest in equity securities, so there you require patience and some more skill. At least you need to know what you are doing. So before we get started as well, there's a nice graph here which shows you the trade-off between risk and return and how the various investments that we have discussed so far align with this trade-off. So, of course, if you are investing in money market or government treasuries, if you are buying treasury bills, treasury notes, you are at the lower end of the spectrum. Low risk, low return. So now if you are investing in treasury bills, you are probably earning around 13 or 14% in treasury bills. If you are doing fixed deposits with a bank, sometimes you can even earn less. If you are buying investment grade corporate bonds, if you go to the Ghana fixed income market and you buy a corporate bond, you would be earning around between 19 to about 23%. Now, obviously, your return is higher, but your risk is also higher. Okay. For example, we've got a company, Produce Buying Company Limited, which has issued corporate debt on the fixed income market. Now, Produce Buying Company Limited's return was in the mid-20s, but when it came to time for them to pay coupon payments, they defaulted, which means that there's a risk. So in buying corporate bonds, you have a higher risk and you get a higher return. Then you move up the chart to blue chip large cap equities. If you were buying a Facebook or an Amazon, your return is likely to be higher, but you've taken on a larger amount of risk. If you go to small cap, which are much smaller companies, you see the risk goes up. The risk increases, your potential return also increases. The next on my line here, you see emerging equities with a higher risk potential. Now, this is where equities on the Ghana Stock Exchange fall. Ghana is an emerging market. So companies here are considered as emerging equities. So here in these are markets, we've got a very high risk as shown by the graph here, but you also get a higher return if you invest in emerging market equities. So as you go up the line looking for a higher return, you see that you'll be taking on a higher risk. So this shows a trade-off between return and risk. And anybody who is looking for the higher return that equities provide must bear in mind also that they are taking on a higher risk in order to get that higher return. So that sets the tone for us to compare equities to other investment alternatives. So if you look at this graph here, it shows you returns on treasury bills of Ghana government 91-day T-bills from 1990. Okay. So I mean, in the peak years when it was 45, 48%, from 95 to 97, of course, we had a lot of economic crisis since then. When T-bills are high, you also have to look at what the inflation is. Investors are happy, but that's not very good for the economy because no company can borrow at these rates and turn them around to pay you. So it's not very good for the economy. But this shows you the history of 91-day treasury bills over the period. 182-day T-bills, again, you see the average return over the period. I mean, highest being 26.3, 24.4 over the period that I examined for purposes of this presentation. The 1-year treasury notes, again, you see the returns from 15 the highest being around 24.52 in 2015. So these are, and then we can compare this to what the returns have been on the stock exchange. Now, where you see red, you see a loss. Where you see green, then you see the positive return. But look at the returns we were looking at previously, where you have 10 and some of the highest being mid-20s, 25, 24%. And look at the returns on the stock exchange in good years. So 93, 94, 114, 124%. In 2003, the best performing year, you had 155%. So you see 46, 91, 70, 31, 58, 32, 79, in years that the stock exchange have performed extremely well. You see that these returns obviously trump considerably what you are seeing in the money markets. So investing in the stock market gives you a very high return, and it's been proven globally that investing on the stock exchange gives you the highest return across all asset classes. But a higher return, as I've shown in the previous graph, comes with a high risk. So we know that there are high returns on the stock exchange, but they come with a high risk. And the returns here on the stock exchange are way higher than the returns on the money markets. But you see that in some years, they're actually losses. So you can make losses if you invest in equities, but your returns are also usually higher than what you get from other alternative investments. I also assessed collective investment schemes because you have fund managers where you can put your money into collective investment schemes and they manage for you. So you have equity funds, money market funds. Again, if you look at those returns, you'll see that compared to the stock exchange returns, the stock exchange returns are way higher than equity funds, money market funds, balance funds, and then real estate funds. Because we'll share the slides with you later on, you can take your time and look at the analysis that I have done to see that returns on the stock exchange actually trump the return on these alternate investments. Okay, so let's talk about the stock markets. When you buy a stock, you have bought part ownership in somebody's business. So FundMill Ghana Limited is listed on the stock exchange. When you go and you buy shares in FundMill, you would have become a shareholder of FundMill, which means you have a say in the way that the business is run and a share of the profits that the business will generate. Typically, how you buy a company is a company share is during an IPO or when it is listed on the stock exchange. So if a company is looking to raise money, it does what we call an initial public offer, where it invites individuals to buy shares in that company. Okay, so you can buy shares when the company does an initial public offer, or you can buy shares when the company is listed on the stock exchange. And there are two things you get when you buy shares: dividends and capital gain. So if you buy shares and a company makes profits and distributes the profits to its shareholders, what you get is called dividend, which is your share of the profits of a company that you have invested in. Capital gain is the increase in share price of a company that you have invested in. So let's look at a case study. So here's a handsome young gentleman called Yao. Okay, Yao likes to think, dream. He has some money and he has a good idea. Okay, why don't I start investing in a cocoa processing plant? Now, I've read that the country is looking to encourage more cocoa to be processed in Ghana. And then we've heard the president saying that we have to increase the amount of cocoa processed in Ghana from 30% to 50%. So my good friend Yao, who has some money, about 3 million cedis, says, I want to set up a cocoa processing plant in Ghana in line with the objectives of the government. And there are several incentives that have been set up for me. So let me establish a cocoa processing plant, put in my 3 million, and find additional money to invest in the business so that I can make a good return. So he does his analysis and he realizes that he needs 15 million cedis to set up a world-class cocoa processing plant to process cocoa and sell in the international markets. And many of you know that when you process cocoa and you are selling, the value. So our good friend, who's a cool dude, thinks, let me invest in a cocoa processing plant so I can make more money. I'm looking to grow my 3 million cedis. I have 3 million, the capital required is 15 million. So what does Yao do? There are two ways in which Yao can raise money. Either Yao goes to look for a loan, okay, he takes debt, or he goes to look for equity, which means he will look for people who will join him in investing in the cocoa processing plant. So as a company, you raise money in two ways, either debt or equity. So debt is where you go and borrow from a bank, you take a loan from a bank, or you issue a bond so people can buy, but that is debt. And then you pay interest on that debt. For equity, you invite other people who have money that want to invest for a return to put money into your business, and so they become shareholders in that business. So Yao has two options, either to take debt or to take equity. So to start with, Yao goes to a bank, and the bank says, okay, we'll give you 5 million out of the 15 million you are looking for. Remember, Yao has 3 million. So he takes 5 million from a bank. So there's still a shortfall. He only has 8 million. He still needs to find the rest of the money from elsewhere. So Yao will then go around and talk to people that he knows that I have an idea to build a cocoa processing plant. I need 15 million. I have 3 million and the bank has given me 5 million. I need to raise the rest of the money from you. And he will tell you about cocoa processing and the prospects of making money in that sector. So Yao will start talking to people to look for equity. So Yao will find the first person, Kojo. He convinces Kojo, who is known from university, and Kojo gives him 1 million. There's still some way to go. So Kojo becomes a shareholder in Yao's cocoa processing plant. He has invested in the plant, he becomes a shareholder. So together they keep going out to look for additional money. They find a couple who have money and they give them 2 million. So this couple also becomes they become shareholders in the cocoa processing plant. Okay. They need more, so they go out and then they find another person, Kindi, who gives them an additional 2 million. Then they go and find another family of people who have come together and contributed called a Minshe family. So they give them an additional 2 million. So at the end of the process, they have raised the money. Between debt and equity, Yao has found the money, 15 million in all, to fund his cocoa processing plant. So he's raised 7 million from shareholders, 5 million from a bank, and 3 million of his own money to make up the 15 million, which he puts in the cocoa processing plant. So there are different shareholders of this plant. 4 new shareholders in addition to Yao. So there are 5 shareholders of the company, and then there's one bank who has invested debt in the business. The 15 million then goes into the cocoa processing plant. So we start business. At the end of the first year, we've made sales of 12 million. Cost of sales is 7 million. Our company makes profits of 5 million. We pay interest on the bank loan of 500,000. So we have earnings before interest and tax of 4.5 million. We pay tax to the government of 1.1 million. Then we have profit after tax of 3.3 million. So fantastic, that's good news. In the first year of our cocoa processing company, we've made profit of 3 million. What will we be doing as a shareholder? Kojo T, you are the shareholder. Would you want to take the profits? Or would you want the company to put all the money back into the business so they can generate new returns? It's always a conundrum, but managers have to decide. So maybe the company will decide that let's share 1 million, okay, of the profits we made to our shareholders. Now the 1 million that will be shared according to the amount of money that the shareholders put in the business. So Minshe family, Mr. and Mrs. Sika, will make more money than Kojo T because they put in 2 million each and Kojo T put in 1 million, if you remember our previous slide. So in sharing the 1 million, the 3 shareholders who put in 2 million will make double what Kojo T made. So that will be the dividend that is shared amongst the shareholders from the profits that a company has made. Now, all of us will be praying that as the years go by, our cocoa processing will be more, we'll make more in sales and we can generate more profits so that the dividends that we get from the company will increase. Now, while the dividend is increasing, our company value is also increasing. Because if you put in 2 million today and the company has made 3.3 million profits and you want to sell all your shares, you will definitely not accept 2 million back. You'll be asking for 2.5 or 3 million, which would mean that you have made a capital gain. Assuming somebody buys the shares from you for 3 million cedis, you would have made a capital gain of 1 million. So you would have made a capital gain in addition to the share of the profits that you have taken from the company. So you've got capital gain and dividend as the return that you make from investing in that company. Now, if you want to sell your shares, Kojo T wants to sell the shares. How will he find somebody to buy the shares from him? That is the first difficulty. The law will say if you're a private company, you should make an offer to the other shareholders. What if the other shareholders don't have money? What do? That is why the stock exchange comes in. So if this company decides to put its shares on the stock exchange, it means that every day people are looking at the company, and if you want to sell, you have the opportunity to put your shares on the stock exchange, which is an open market, and people who are interested can buy on a daily basis from you. Okay. Because there are difficulties in finding somebody to buy your shares if it is a private company. So that is where the beauty of the stock exchange comes in, where we match buyers and sellers together. So that if you are an investor and you are looking to buy stocks, you go to the stock exchange, you will find a company where its shareholders may be looking to exit, and then you can buy from that person. So that is where the stock exchange brings buyers and sellers together, especially investors that are looking to make capital gains and dividends from investing in stocks. Okay. So after some years, our business decides to expand, which is our cocoa processing company, or some shareholders want to sell. So we take our money and we go public. We put our company on the stock exchange. Okay. We do this through brokers and other agents who advise us as shareholders of our cocoa processing company to do an initial public offering where we will sell our shares for the first time to the public. People will buy, and then after that, our company gets listed on the stock exchange where people can now start buying and selling shares that they have bought from our company. So when it comes to stock exchange investing, there are buyers and then there are sellers. Okay. And the stock exchange, whether it's the Ghana Stock Exchange, the London Stock Exchange, the New York Stock Exchange, the Hong Kong Stock Exchange, is the same market where buying and selling takes place. So it's a facility that ensures that there's transparency in anyone. So buyers are guaranteed open. There are buyers and sellers in that market. Now, just like you go to Agbogbloshie or you go to Malata market, buyers and sellers determine the prices of stocks. So like tomatoes, when you harvest tomatoes and there's a glut, a lot of tomatoes on the market, you see that the price comes down. When the tomato runs out of season, you see that the price of tomatoes go up. So it's driven mainly by demand and supply. In the case of the stock market, the company's demand and supply is driven by performance. So where our cocoa processing company is making a lot of profits, more people will want to buy. So demand will go up, less people want to sell, so the price goes up. On the contrary, if our company is not performing too well, less people want to buy and more people want to sell. At that point in time, we realize that the share price comes down. So share prices go up and come down, driven mainly by demand and supply for that company's stocks. So the better a company performs, the more likely that its share price is going to go up. And the reverse is also true. So when you are going to invest, the first thing is you look to buy companies that you think their share price are going to go up, because you want to buy at a low price and sell when it's at a high price. That is what investors look out for, or that's what you should be looking out for when you are investing on the stock exchange. Yes, you can buy stocks through lots of brokers in Ghana. Okay, but now let's look at a typical example. Fan Milk Limited. From 1990, today. You see how the graph looks here. Over the years, the company's share price was stable or flat. It goes up, there's a bit flat, dropped a bit. It goes up again, it dropped considerably. And then it went up, it drops. It went all the way up, and then it's dropped significantly again in the year-to-date performance. So over the years, you see the performance of FanMilk. Now, every investor looking at this, your aim or your main objective should be, you could have bought FanMilk at around 2 cedis here and sold at around 6, where you make a gain, or you buy FanMilk at around 5 cedis here and sold it when it was around 18, you make a good return. Other investors may have bought FanMilk when it was around 6 and sold it when it was around 3 cedis. You will make a loss. So you understand the principle of buying low and selling high. Let's look at Ghana Commercial Bank. Over the years, moving from around 20 pesos when it was issued to about 7 cedis, all the way down again to around 5 cedis, came up 3 cedis, came up to 5 cedis and has dropped. Again, every investor would be looking to buy stocks when it's low and selling high. So several times I've heard people say investing in the stock market is never good. I put my money on the market and I lost a lot of money. It's also mainly because this investor probably bought at this level and sold at this level and made a loss. And then you find people who say investing in stock market is the best thing in the world, and I'll never buy any other investments because this person probably bought at this price and sold at this price. So the returns are immense. So timing means a lot when you are investing on the stock exchange. The timing of your investments means a lot. Let's look at CPC, one of the most bastardized stocks on the market because it's been flat for a couple of years. So even for CPC, it started off quite well, went up to 0.1, dropped and dropped since then, and stayed flat, over the last couple of years. CPC has been flat. But even with CPC and all its troubles, it has a tendency of moving between 1 peso and 2 pesos. And if you move from 1 peso to 2 pesos, it's 100%. So even for CPC, where people think this is the worst stock on the exchange, people are still looking at 100% and 50% margin on a regular basis. So there's no such thing as the worst stock that does not give you any return. It just depends on your timing. Let's look at another stock, BOP, which is Benzo Oil Palm Plantation. Again, you see the fluctuations over the years. It goes up, it comes down, it goes up, it comes down. So at which point in time are you buying the stock? It's important that as an investor, you should know. Is this a good time to buy? Is this stock up? Is it down? What is the general trajectory of this stock? Am I supposed to expect an uptick, or am I supposed to expect a downtick? So you must know at which point in the retail or investment life cycle that the stock that you are buying is. Look at Total as well. So in one particular year, let's look at the share return from Total. It drops again, and then you see the other fluctuations. But look at the graph from 1992 all the way to about 2009. It's going up consistently. So over all the graphs that we've looked at, you see that if you take a gradient, you see an upward gradient, just that there are fluctuations in the actual curve. But over the years, you see that the stock price keeps going up consistently. Okay. Now we have a downturn, you see the stock prices are low. All the graphs, you see that most of them show that the stocks are declining. So share prices are down. It's also a sign, because every time stock prices are going down, it's probably a time that you should be looking to enter the market. Because remember the principle, you buy low and then you sell high. Look at GOIL. It's had a short-term blip, but again from 2008 all the way to 2020, you see the upward trajectory throughout the period of its listing. Yes, there's a blip, there's a time that it dropped between 2006 to 2017, but since then it's also been on the upward trajectory. So generally, all the stocks and the prices are driven by the performance of the company in question. If a company is performing well, then you are more likely to have a good return from that company. So we will be asking ourselves, what company am I buying? What is the historic performance like? What is the future like? What are the key drivers that are going to make this company profitable going forward? And remember, all these that I've shown you is the history, it's not the future. So history is just a guide, but it's not a guarantee of what is going to happen if you invest in this stock in the future. Again, let me say that past performance is just a guide and not a guarantee for what is going to happen in the future. So let's look at some sample returns again from the stock exchange. I've picked the same stocks. So let's look at FanMill. Between 1995 and 2000, and this analysis has been done in 5-year cycles because investing in stocks is a long term. So I've done this in 5-year cycles for the benefit of those who want to see, 5-year investment cycles. So 220% over 5 years for FanMill from 95 to 2000. The next 5 years, 2,000%. The next 5 years, 177%. The next 5 years, 5.41%. So you can see the up and the downside of investing in FanMill. This year, the stock has dropped 74%. So perspectives. Somebody who was caught in this would say it is the best possible investment you can ever find. You won't get this 2,000% anywhere. Maybe unless you're doing drugs, which is illegal, but you won't find this anywhere. Now let's look at CPC. 5-year cycles, first cycles, negative 70%, second cycle, negative 33%, year to date, 50%. GCB, first 5 years, 1,236%. The next 5 years, 27%. The next 5 years, 686%. This year, down 27%. Bob, first 5 years, negative 26%. The next 5, 754%. Total, again, you can see first 5, 236, next 182, next 74, the next one a drop, this year is down 21.5. For GOIL, which has been recently listed in the last 5 years, you see 517%, year to date 11%. So some of these returns that I'm speaking to you about are real. They are actually being made on the stock exchange and people are making money from it. Once you're able to understand what you are getting into, understand the timing, you know that you can make money if you invest on the stock exchange. And the returns here trump anything else that comes from other investment vehicles. The good thing is that you can always get out of investments that are not performing well and buy ones that are on the upward trajectory. That's the beauty of the stock exchange, because trading takes place every day. You can always sell and buy into another stock that has or is showing more potential to go or to give you a return. So what do you look out for? Potential risk of the sector of a company. So let's look at Guinness Ghana Breweries. What are the risks if you want to buy Guinness? So if you're analyzing it, let's look at the entire alcoholic beverage sector in Ghana, because that is the competition. It's not just Guinness, it's Casa Preco. Okay, Guinness is competing against all the alcoholic beverages, and there are several of them. Keba Shaw, Joy Daddy, Alomo. I'm sure you know all these things. They are all competing for the people, for the same pockets of the people who drink alcohol. So what are the risks of the sector? So a couple of years ago, when we were analyzing this, we saw that the sales of Guinness were declining, whilst a lot of the other alcoholic beverages were increasing market share. So if Guinness continued to do what it was doing and didn't innovate, their profits were going to dwindle significantly. We realized that Guinness knew what they were doing because they started doing origin bitters. So they introduced a product that was going to compete with the other products that were gaining market share. So they introduced origin bitters, and then they introduced origin beer. And you realize that the company's margins started becoming more stable because they were able to compete. Now they have a market leader or a product that competes for market leadership in origin beer. So we look at the risk of the sector and how Guinness has been able to mitigate it. Now, this information is publicly available. All you have to do is open your eyes in analyzing that company. Okay, so this is a typical example about analyzing Guinness Ghana Limited. And you see, in terms of strategic direction, they are introducing other products. So every time you are interested in a particular company, whatever news that comes out of the company, you will follow. And that tells you the direction that that company is going and influences your decision as to whether you should be investing in that company or you should be selling out of that company. And you look at the revenue generating ability. Now, this you will find in a company's annual reports. Most of the time, the annual reports are put on the company's website. So you find the annual reports there, or if you go to the Ghana Stock Exchange website, you'll find information about the financial performance of the company, which will then guide you to determine what the revenue generating ability is for the company. As the company being run efficiently, so you look at how the company is running costs, so what the profit margins are, what the efficiency ratios are, then profitability. How have profits of the company grown over a period? Okay, so you can compare year on year or look at the last 5 years. Most of these have also been put in research reports by brokerage companies, which are shared. If you go to the websites of some of the brokerage companies, you can subscribe to newsletters that will give you information on profitability of some of these companies and potential growth of these companies. So you need to look out for this. If you want to do your own primary research, then you can look at the annual reports of the companies as well as the periodic financial releases of these companies. They are also published in the newspapers or on the stock exchange websites. Or if the company is a regulated entity, then you can check the regulator's website for any news, which may seem to suggest that there is a challenge with that company. If it's an IPO, you can also check the prospectus of the company. Then you can just look out for general news about the company on general websites. If a company has signed a new contract, it will be in the news. If there's any negative, effect on the company, it will be in the news. So you should just read out why about any target company that you are looking to invest your money in. And there are various sources, including the ones that I've mentioned, where you can find information about the company that you want to put money in. How do you invest? So assuming you haven't bought shares before, this is a very simple flowchart of what you should do to invest, or if you are interested in investing on the equity markets. So to invest on the market, you have to go through a broker. You have to open an account with a stockbroker who then is mandated to buy or sell your shares for you. You can't go directly to the stock exchange to buy or sell shares. You have to go through a broker. So you need to open an account with a broker. The broker will open a depository account for you. Now, when you buy shares, now it's kept for you like how you keep money in a bank. And that account is called a depository account. So once you open that account, when you buy the shares you own are deposited in that account for you. And if you want to sell, it's taken from the depository account and sold, and then the money is credited to your bank account. Now you open this depository account through a stockbroker. So once your brokerage account and your depository accounts are opened, then you fund the account. You make money available to fund the account to buy the securities that you are looking at. Between you and your stockbroker, you can decide on what securities actually meet your investment goals, and then you buy. But then you have to monitor. As per the graph that I've shown you, share prices go up and come down. So you've got to keep your eye on the shares that you have bought to be sure that it is giving you the right return. If it is not, you can always sell out and buy, another stock. So you've got to regularly monitor your accounts. Thankfully, every day, if you watch the business news, you see the share prices showing on the screen. Hopefully, you're not one of those who tune off and go and watch the other soaps when the business news is running. If you look in the newspapers every day, you see the results of trading on the stock exchange published in those newspapers. So you can check and track how your investments in shares are performing by looking at these news channels. And then you can take a decision as to whether you should buy more, you should sell out and buy another stock, or you should just hold. Now, a lot of people also are now marketing international securities. But it's the same way. You can open a brokerage account with an international broker who will give you access to buy either a Facebook or any other stock that you are interested in. But you need to buy it through a broker. So given the limitations of time, I try to use one benchmark, which is the price to book. Now, the price to book is a very interesting benchmark if you are looking at analyzing stocks. So every company has a book value, which is how much the company is worth based on the assets in that company. So we look at the price of the company and compare it to the book value of that company. So if the company has assets worth 100,000 and liabilities worth 200,000, the assets worth 1 million and liabilities worth 200,000, we'll say that the value of that company is 800,000. It means if you take all the assets and you sell off the liabilities, what will be left is 800,000. So that then becomes the value, the book value of that company. Now, if as a shareholder, you are going to buy that company, it means if anything happens to that company, what you will be giving to you is the net assets, what will be left after the creditors have been paid. So when we compare that to the price, we call it the price to book value. So we check how many times the book value you are paying to buy that company stock. So if you buy the stock maybe 1 or 2 times the book value, sometimes it's fair. If you buy it at book value, it means that if anything happens to the company and we pay off all the creditors, you get your money back exactly. Now, there's an interesting phenomenon on the stock exchange now because a lot of the companies, because their share price have declined, they are trading below the book value, which means that even if you buy the company at this current price and the company collapses and they sell all the assets to pay off the liabilities, you even get more than the money that you put into the company, which means that the companies are undervalued if you are looking at the value investment perspective. So if you look at Access Bank, for example, it's trading at 0.81, which is below its book value. The book value would mean that it is 1. If you look at Aluex, it's 0.58, Bob 0.84. If you look at Cal, it's actually even less than half its book value. Camelot is same. Ecobank 0.85, Enterprise the same, ETI the same. So we realize that this is actually the best possible time to be going into stocks, but you must be patient because a lot of these stocks are trading way below their book values. Historically, a lot of them have been trading above their book values, but because of the times financial sector crisis, which came after power crisis, doomsday and everything, we've had challenges to our economy, which have challenged the companies. But there's been slightly turnaround in the fortunes of these companies, but it hasn't been reflected in the share price yet. So you see a lot of them trading below its book value. So if you want to buy shares, you're looking at the stock market, probably a perfect time for you to be getting in. Now, all the things that I've discussed are also the same things that you'll be looking out for, whether you are buying local equities or you are buying international equities. You should be looking out for the same risk, the same profitability, the same efficiency, right? The same ratios. You analyze them using the same ratios, whether local or international securities. So I've given you hints as to companies on the stock exchange that are looking like they will give you a good return going forward. But you need to be patient. And let me add a caveat. Past performance is not a guide. And the fact that I am saying they are recommended by doesn't mean you should actually go and buy it. You must do your own research and consult your broker. This is just a recommendation. It doesn't mean go and actually buy. I'm just giving you my own analysis based on my perspective on the exchange so far. Okay, so that covered. Let's go over why you should invest in the stock market. We've spoken about the investment gains and the capital appreciation. You've seen the actual percentages yourself. Okay, over the years, what companies listed here on the stock exchange have been able to deliver to investors. Okay, but remember the risk-return trade-off. And remember also that the rule was that we try to buy low and sell high. So you have to look at the point where it is low get in and get out when it is high. Okay. You also get dividends. So capital gains, we've spoken about what to look out for, what to do. Dividends, you don't have too much control over. But if the company makes profits, then it will share its profits amongst the shareholders. But before you buy, you also look out for companies that have been known to pay good dividends. Typically, the multinational companies pay a lot more dividend than the local ones because they have to send money home. So if you are an investor that prefers dividends, you'll be looking for stocks from that class. And we also said you have to diversify. You've got to put your investment in different types of investment products because one of the principal rules of investment is to diversify. You don't put all your eggs in one basket. So maybe 30 or 40% of your total investments will be in the stock market. The rest will be spread in other investment vehicles. So you need to diversify. So I guess I have gone over why you should invest in the stock market, what you should look out for, what investments in the stock market entails, the two things that you get, capital gains and dividends, the trade-off between risk and return, and how you should actually start by opening an account with a broker and the process that you have to go through to invest in the stock market. So I think it's just about time. Let me just go quickly over the rules of investing. If you can, you get started early. You invest consistently. Think long term. My all-time favorite client was, a civil servant who would come in every week and bring in money. When he went on retirement, he had a portfolio of 3 million cedis, which was the envy of all. But just investing consistently and thinking long term, he was able to hit 3 million by the time he invested. And I think he invested over a 25-year period. But it reminds me all the time about investing consistently and then thinking long term. And then you must diversify. Okay. Don't borrow to invest, unless, of course, you are guaranteed that the return is going to be higher than your cost of borrowing. If you can't guarantee that, then use your own funds. Invest in what you believe in. Okay. So you must understand what you are doing. Don't go and buy an Anglo Gold thinking that they will be sharing gold. You must understand what you are doing so that you can analyze. And then when there are short-term fluctuations, don't panic because in the long term, as you have seen from the graphs, it always evens out and it gives you a return. So I guess I'll stop here. And then if you have any questions and answers, we can take them. So if you do, I guess the rule was that you can either type in the chat your questions or you can raise your hand and then we will call you. Thank you very much for your time so far. Okay, so Martin has a hand raised. So Martin, you can unmute yourself and then ask your question.
In the Ghana Stock Exchange, though, we do realize that there isn't a lot of liquidity in the system. So sometimes looking for very good stocks, you find that people are just sitting on them and are not prepared to sell. And if they are going to sell, they're selling at prices which you are not prepared to pay for. How does one deal with situations like that when you are looking for the long term and stocks are just not available? The stocks that you want to buy are not available for purchase.
Okay, good question. I think that liquidity is generally a problem with emerging markets. Wherever there are liquidity challenges, you also see that some of those markets also have potential high returns. So it's something that we deal with. But I think that you need to stay close to the broker because these equities become available, sometimes it's a buyer's market, sometimes it's a seller's market where the same equities are available and no one is buying. So it's about timing and it's about being close to the broker. So timing really matters and being able to be there when the stocks are available. Okay. It's not, there isn't a one-off solution where stocks will be available the day you want it. But when you place your order and you stay close to the broker, I think the market turns around from time to time. Okay.
Thank you.
Most welcome, Martin. So if you have any question, again, you can raise your hand and then I can call you out, or you can type it in the chat to me, and then I can ask the question.
Okay, I've got another question for you, David. This is specific to one stock that I like a lot of, but for some reason, it just doesn't seem to be doing very much. It seems to be way below its valuation, and that's MTN. Can you give us some more insights to the MTN story?
Okay, so your first question was the fact that there was illiquidity around some stocks, and so it was difficult to buy. MTN is on the other extreme. There's a lot of liquidity in that stock. Okay, so what happens is you've got a lot of people buying and selling the stock very frequently, and you have a lot of retail investors that bought during the IPO and that are just looking to sell just to get liquidity or to get cash out, and they don't mind the price. Okay, so MTN is suffering from having a lot of liquidity in the stock. So because a lot of people are selling at the same time that they are buyers, they are almost evenly matched. So the price doesn't go up. You actually tend to have a lot more sellers coming in, and you find the price declining. So that is what MTN is suffering from. Very much not linked with its performance. If you look at the performance of MTN, especially full year 2019, you think that this price should be going through the roof. But because there's excess liquidity on the exchange, the share price has tended to be flat and has actually declined a bit. If we get one serious buyer coming in, this is going to change very significantly. So be patient with the MTN stock.
I think we have Peter. I can see a hand.
Okay.
If you have a question, please unmute yourself and go ahead.
Simon, my hand is up.
Okay, Simon, please go ahead.
All right, thank you. Unfortunately, I couldn't join earlier because I had some network challenges, so I joined somewhere later. But then going through or listening, I am so interested in stock, and I've been following online and others. I know that in the international market, you have some websites like Trading 212, Robinhood, and others that you can trade penny stocks and others. So I want to find out in Ghana, are there some specific websites or, as it were, companies that you can just do it online?
Okay. Yeah, very good question, Simon. Yes, there are ways in which you can do your trading online. I think DataBank has an online platform. Recently, IC and MTN have launched trading online. I think if you go to your *170, you can actually see a point where you can trade in stocks. So that is also available. I know some new platforms that are coming up, cdmanager.com and others are all available for you to be able to trade your stocks. Okay, so that's to Simon's question. How does one buy stocks outside Ghana? This is Henry. I mentioned earlier during the presentation that if you want to buy stocks outside Ghana, you would need to open a brokerage account with an international broker. And a lot of them are online, but you need to be careful. Read a lot of them, read a lot about them before you decide on which one you want to open an account with. But there are some local brokers too that are able to help you buy stocks outside Ghana, especially if you have a significant amount of money. So you can look out for that. You missed out on the IPO of MTN. Can you buy MTN at this time? The answer is yes. I again pointed you to the *170 menu. Or if you go to any broker that is licensed by the stock exchange, you will be able to buy shares of MTN through any broker. And the shares trade every day between the hours of 10 to 3 p.m. So you can buy steps at any point in time. Samuel is when a company declares dividend and it's more 2 months and you haven't received your dividend income, whom are you to contact for your claims? Okay, so every company has a registrar. Every company has a registrar. So depending on the company, you go to the registrar. There are about 4 registrars in all. NTHC is one, GCB registry is one, UMB registry, and then the Central Securities Depository. between these four registrars, they handle all the companies that are listed on the stock exchange. So you need to find which of them, is responsible for your company that has paid the dividend. You go to them and then they can solve the problem. Dividends also don't expire. Anytime that you find that dividend warrant, you can go to the registrar and then they will reissue your dividend for you.
There's one from
hello.
Yeah,
Thank you,
at
David.
40, what should your portfolio?
Okay, before that, at 40, what should your portfolio be like?
Yeah.
That's an interesting one. I can only give a general answer and not specific because there are different circumstances for different 40-year-olds. There are people who are 40 and are now going to get married. Okay, there are people who are 40 whose last ones are.
My question: no companies listed on the stock market. Good.
Peter, I'll get to you. Let me finish with the at 40 question.
Mm-hmm.
It depends on your circumstances, really. But like I said, generally, a general answer is that your portfolio should be diversified. Typically, because your retirement age is 20 years from now, which is 60 years, you still have enough time to do long-term portfolio. So you can be swayed a bit more to a few more risky assets, and then the rest, maybe 40, 30%, can be in less risk-free assets. But that's a general answer. For a more specific one, we need to discuss your own personal circumstances. Okay. The next question is Frederick. My first investment in stocks was when I bought CPC shares. And unfortunately, that is what broke my heart on stocks too. I can relate, Frederick. I hear a lot of that. Is it still trading? And does it have any hope? I want to sell, but I was told no one wants to buy. Can I go buying for those who are selling? Thank you. Yes, Frederick, again, another myth. I wonder who told you that nobody buys CPC shares. If you look in the papers, you see shares traded CPC. There's a figure there. It means people are buying CPC. It is never true that you cannot sell your shares. There will always be a buyer. Maybe it will lag. There will be some time, but there is always a buyer. CPC is a particularly interesting one because it broke the hearts of several people because it was the first time that people were buying stocks. But I'll tell you my personal experience with CPC in my office. When CPC goes down to 1 peso, I buy, and then I sell it at 2 pesos. I make 100%, and I wait for it to come down to 1 peso. I buy, and I sell again at 2 pesos. So every cycle I make is 100%. So when the whole world complains about CPC, I actually praise it a lot. Okay, so there are different perspectives when it comes to investing. So Frederick, don't give up. CPC should not break your heart on stocks because, as you have seen, there's still a lot of return to be made from buying equities. And if you want to sell your CPC, there's a willing buyer. You can find a buyer. Okay. Someone wants me to type the 4 registrars here. Okay, I'll do that at the end. Frederick, again, what is the minimum amount you need to invest in stocks? Well, there's no minimum, Frederick. I said you can take a long-term perspective. You can start with 100 and keep doing 100 a month if you so want. There is no minimum. What you need to do is to have a plan and invest consistently. Because if you put in 50 CDs, that's not the end of it. I'm sure your intention will be to build on it as you go on. So there's no minimum. Samuel is asking if it is equally good to invest in equity mutual funds. And the answer is yes. If you don't have time to be able to do the analysis for yourself, you don't have time to be able to monitor the investments yourself, yes, it makes sense for you to put your money in an equity mutual fund that is managed by a professional fund manager. Because in the end, you still benefit from the returns that comes from equities in you. Just that you also need to compensate the manager for his effort in managing your funds for you. So yes, it's a good vehicle to put your money in. So I think I've pretty much covered all the chat. Oh, there's more.
Caritas' question is here now.
In valuing stocks by discounting free cash flow, how do you then value if the business generally has a high capex and hence negative free cash flow? Which other discounting method is available? Oh, Karen, so when it comes to valuation, discounted cash flow is just one method. Okay, if you are valuing banks, for example, you'll be looking at book value, and there are different other valuation methodologies apart from the discounted cash flow, price to sales, EBITDA. So there are different ways in which you can value a company. I'm sure we can go through that if we have another session. But companies that have negative cash flows, there are other ways in which you can also value them, okay? Especially if you give a greater weight to their assets. Okay.
Okay.
Was somebody else?
Hello, Mr. Tete.
Peter's iPhone.
Yes, my question is, companies listed on the stock market, they go through a lot of regulatory processes. But how come UT Bank was able to fail, even though it's listed on the stock exchange?
Okay, that's a good question. And I've heard this question several times. Can a company that is listed on the stock exchange fail? The answer is yes. The stock exchange does not necessarily run the company. The stock exchange is responsible for putting in place governance requirements and reporting requirements for companies. But it is the company itself that is supposed to run the management and the directors that are responsible for running the company. So yes, in the case of UT, UT is a bank. It was regulated by the Bank of Ghana. Okay. It's also listed on the stock exchange. Can this company fail? The answer is yes. The likelihood of such a company failing is low, but it's still very possible. Globally, we've seen companies like Enron, Welcome, all fail. These are large listed companies that were even audited by the top four. But it comes down to the people that are running the business and what decisions they are taking for that business. But companies can generally fail, and that is a risk that we face when you are investing in stocks. So that one, nobody can deny that these companies can fail. They fail, usually is a blot on the markets, but generally, if you have diversified your portfolio well enough, it shouldn't disturb your investments in the long term.
So does that mean when they submit their financial statement to the authority, they don't scrutinize those? In the case of Enron, we find out that there were accounting malpractices. So the promoters or the directors of the company were held responsible. But in the case of UT, there hasn't been any concrete evidence why UT Bank failed.
Oh, Peter, I'm sure the analysis has been done. If you recall, at the time that the Bank of Ghana was revoking the licenses of UT and other banks, there were a lot of reasons that were cited. So if you go back to that report, and I think it's still public, you will read about all the reasons why the Bank of Ghana revoked the licenses of UT. They gave all the specific reasons, and at that time, they gave the follow-on. Part of the assets went to GCB, part of the assets went to a receiver, and they gave all the processes that depositors were supposed to go through. So I think that was quite clear in the press release that the Bank of Ghana issued about the reasons why UT failed.
Hey, Mr. Tete, please, there was one that I think we missed. One question, somebody asking, what would you say is the key take-home message of this presentation, since they have heard a lot? So can we please look at that? Okay, so I will sum up and say, I wanted to do it at the end, but now that you've brought it up, I'll answer it. First of all, investing in stocks gives you the highest return as compared to all other securities, but there's a higher risk to it. Because there's a higher return, there's a higher risk to it. And it is still worth it to have some stocks in your portfolio because the returns are high. So I think those are the three key things I'll leave with you. Okay. So there's a question from Frank Anderson. I think it's a good one, if we can look at that in the chat.
Yes, in your presentation, the past performance of CPC was low, but in the other slide, the year to date is 50%, while others are negative. Does it mean they are doing better this year? I guess the answer is yes. So on the market, CPC's return this year has been 50%, and other companies have been negative. So all the stocks don't go in one direction all the time. That is why you have the opportunity to buy and sell every year, every time. So this year, CPC's return has been 50%, others have been negative. So it's a good catch, Frank. It's good you spotted that, but that's the truth. Fred again, most staff with brokerage companies don't take much time to explain into detail when you want to buy stock. or need information, and much attention is given to stocks that are doing well. Any comments on that? Frederick, yes, I will align with this comment. I've run a brokerage company for several years, and I know what you are talking about. Unfortunately, and I'll spell the unfortunate truth. You know, as brokers, we get paid from the commissions that we make when we trade for you. When we go and sit in front of a client that is giving us 100 million, it's the same analysis we have to go through as a client that's going to give us 100 CDs. So naturally, we tend to focus on the bigger ticket deals. So I've got to admit that we are as guilty as you have said here, right? But there are different kinds of brokers, okay? So you need to find one that will have time and explain for you. And most importantly, you need to do a lot of reading yourself, so that by the time you go, the questions are straight to the point, okay? And you can get quicker answers out of them. I mean, in my early life, people will come and ask me 3,000 questions and then give me 50 CDs. You know, so sometimes when they go, I'm like, bye. So 2 hours and I'm not going to earn any commission. So we try to balance the two. So what the observation you've made is very, very true. That is why globally it is the online businesses where they give all the power to the individual to be able to read, understand, and trade. That's why we are pushing a lot of the things online, because it's difficult to service multiple clients when it's just a few brokers. So it's a very good observation, Frederick. If you come to me, I'll have time for you. Okay.
Okay, please, is there any more? So Mr. Teta is asking that all of you should go to him for service, right?
Yes, if you come to me, I'll give them very solid service.
Good. Is there any more questions? I think we've had a lot to take in today, a lot. What I am taking home personally is buying stocks requires a lot of homework. I mean, you should do reading. If you are the type who doesn't like to do research and reading, then you should reconsider, because a lot depends on you and the knowledge that you have going to invest into a particular company. I mean, that is what I have learned. So we shouldn't just depend on what our brokers tell us, but then you do your homework yourself, mostly. Okay, yes, somebody is asking, can they get the presentation material? The video will be put on our YouTube page, Ghana Talks Business YouTube page. So you can go there. When it's ready, we will send you the link. We have everybody's contacts on WhatsApp or email. So we'll send you the link that the video is ready. Then you can go and watch and then take your time and take things in. Okay, thank you.